What's going on, everybody? Do I have audio? Good morning. Good morning, everybody. Please tell me I got audio right now. I can't tell. Is anyone there? Hello? Good morning. Heck yeah, all good. That's what I like to hear. Audio is good. All right, guys. We got 40 minutes. I just wanted to get on here early like I always do. Connection good? Everything good? Connection good? Let's go. We are ready. Everything's good. Heck yeah. Let's go. Live. Just gotta do a couple things. Let's go. We're back. I know people have been frustrated this year. Let's see if we get out of this little hole we're in. All right. There we go. Let's go. Here we go. Everything's good. All right. Boom. You guys can do me a favor and just share this everywhere. Twitter, StockTwits, forums, everywhere. Just share this video everywhere. Let's go. Alrighty. Let's see what we got here. Let's see the comments. You guys are pretty happy today. People haven't been happy this year with me. People have been, what the heck happened, Kyle? What happened? I'll tell you what happened. A 50% drop happened. That's part of these growth stocks. That's part of these companies, guys. These puppies can go down 50% in a blink of an eye. It's part of the game. Once those tariffs came out, we were doomed. We're slowly making our way out of this funk, slowly. There we go. Let's do this. Come on. Bought calls. Yeah, guys. This room I'm in, it's not very soundproof at all. Probably gonna hear my dogs. I couldn't film in my other room. He said I could hear birds. I'm in Florida, guys. I'm in Florida. That's funny. Birds are chirping. Let's go. Guidance. Oh goodness. Guidance is important. We know that. I'll tell you what, guys. This is the best I've slept before earnings call in like 2 years. Like this was the best sleep I ever got. This is right now I'm just feeling like SoFi is just there, it's about to become a monster. Like it's so close to having that special quarter that it just wipes out 40 community banks. Like that those banks will never catch SoFi ever again. That's where we're at right now. Just we're at that level of just wiping out 50 community banks. We're so close. Putting up 1 million members. You know, that's gonna be coming soon. We need to put up 1 million members. Soon we're gonna be putting up $1 billion a quarter. Start to do the math. What happens when you do $1 billion a quarter? You're already at a 4 billion run rate. What happens when you get to 2 billion a quarter? You're at 8 billion. You see what I'm saying? These things are starting to happen. The compound quarterly growth effect it's starting to happen, okay? If our stock just gets a little higher, like if our stock's at the 25 to $35 range, this stock's eligible for S&P 500 because it's got that growth, it's got profitability. It's close, guys. Yeah, you're likely going to get the two guidances. You're going to get a full year guidance and you're going to get a Q2 guidance. So we can't have one or the other. We got to have both propped up. Maybe they go full year, pump it up 2%, and then maybe the analyst expectations, they meet it or beat it by 10 million. That's all we really need. So yeah, we need both. Good morning. I'm hoping up. If you look on my Twitter, I did a post. We were I think down the last 3 earnings reports. So 3 earnings reports in a row, they were all down. That was the last 3. We had a pump like 5 quarters ago, and that was just a pump for no reason because think about how small the company was 5 quarters ago. It was at like 16. I don't think you could say it really dropped before. It was just at like 16. I've been hearing this forever. I can't see that one anymore, man. I can't accumulate a stock for 3 years. I can't. I'm ready to go. Let's just get it moving. 35 minutes, 7 a.m., 7 a.m., 7 a.m. Hey, if Noto wants to make some money, he can't sandbag. If he wants that 300 million, if you want to hit $45, I understand you're building a stock for the long term, a growth company for the long term. You can't sandbag a Q2 off tariffs. You can't do it. You got to go for it. You got to go for it. Only bag holders. Yep. SoFi right now could potentially be at 11.2 million members, maybe. What if it's at 11.3 million members? We know we're over 11 million. Let's go. Wow, that's awesome. Hey, all they got to do is let it go. Once they let it go, they could pump it to. I keep saying, I keep telling people when they actually pump this thing for real, like you did see with Robinhood and like you saw with Hems, where both those stocks they get to unjustified valuations, and that's when you trim a lot or sell a lot. You got to wait for the unjustified value. Okay, when you saw Hems and Robinhood both hit 70, look what happened. They both went from 70 back to 30. You see what I'm saying? So I'm not really worried about these small fluctuation moves, 15, 18. I'm waiting for the big move, and then I could sell a lot, and then accumulate more shares. But just I'm not really worried about these small moves. Everyone gets excited. Oh, we're at 18. Like that's not the true value of how this company is growing. You know what I mean? We're waiting for the big move that's not justified. Okay. That's what we're waiting for. These little 12, 14, 16, it's just I don't even pay attention. Okay. We're looking for a big return. He sandbags because they're a bank. They do a lot of lending, and lending can get out of control pretty fast if the environment folds very fast. So he likes to, and we've had just terrible environments. We had the interest rate increase for 2 years. We had the interest rates decline. We had no student loans. We've had a lot of weird environments, to be honest, since the pandemic. So he just always seems to be conservative, and he's been saying 2025 is going to be the best year for SoFi if he says the best year for SoFi is 2025, hey, we're already 5 months into 2025. We better get some strong earnings. Guys, please like this video, share this video. Earnings are 30 minutes away. Okay, let's pump this video up. Okay, it's gonna be awesome if we actually have a blowout and it's the best earnings in SoFi history. That'd be great. But my expectations, as you guys can see in my last couple of videos, I mean, they're not really that high like they have been because they've just. I was surprised they went conservative on the EPS. They're not worried about profitability. They want growth right now. They want members. They want this market share. Okay, that's all they're worried about. So my EPS, they said 3 cents. Give me 4 cents. I'd even say 5 cents. Give me 4, maybe 5. I don't really care. Okay. I'm not really blowout numbers like I was the past 2 quarters or so. Revenue, I'm not even asking for 800 million, but I want it. You saw my Twitter last night. I want an 8 handle. You give me 8 handle, I'll be like, dang, we're moving up. 800 million, that'd be nice. I'm not even at 800 million. Okay. I'm thinking 780 million, 4 cents EPS. My guidance is just, it's not even high. So that's why maybe that's good. Maybe that's good for us that we're not everybody expecting blowouts. But let's see how this TGL did for market share. What if they did get 900,000 members? That'd be crazy. Yes. I'm a little behind. I got to get moving up. Oh yeah, 2030, man, guys, we're gonna be printing profits. Could be 2-3 billion. Easily $2-3 billion in profits. That's put a 30 PE on 3 billion in profits. Boom. You know what I mean? You're a 30 PE. You're 75 easy. Australia. Yeah, I told you guys I wasn't filming. I said I don't care about the content right now. I don't care about the hype, getting people crazy excited. I don't care. I want to see the stock really move up. So let's see what happens. Let's go. Yeah, we're getting there. We're getting close to that. Yeah, 40. Yeah, I mean, I might trim at like 28, 30, like a teeny bit trim. But like, offloading, if we're saying like offloading like 30, 40, 50%, and then just going long 15 years, another 15 years long, but like not having to worry about it long. But I want to trim like 40% at like $45, which is potentially the bonus compensation. But yeah, anything in the 20s, I don't really care. Let's go. It's possible. Maybe something small. Yeah. Let's go, guys. This is it. This is it. Yeah, exactly. I'm waiting too. Yeah, look at that. Boom. I told I like because this is so early and I've been doing these earnings for so long. I totally forgot crypto's back on the table again. It's just that could be 3% of our business and in the future, 5% of our business. That's good. More diversified revenue streams, lower risk. Yes. I don't know. Maybe if someone offered Noto $30 right now, I bet he'd take it. Why not? Go off into the sunset at $30. But anything less than that, there's no way because he built this massive foundation, with all this marketing, all these acquisitions. Even at $30, maybe that's a 20% chance he does something like that. Let's go. 7 a.m. 28 minutes. Let's do it. Yep, 7 a.m. That's what I'm saying. It's 5 years from now, this is gonna be a giant, man. I mean, I don't even. I have a couple things in my notes how big this revenue could get that fast. I mean, if they knock out 5 years in a row of 30% growth, I mean, the bottom line is gonna be looking crazy already. Let's go. Let's go. We should break every record, guys. Every record. Revenue, EBITDA, members. Yeah, revenue, EBITDA, and members. We should break all three easily. Yeah, it's possible, but man, they've been signing a lot of loan platform deals, and that ain't really getting slowed down by the tariffs. I do a home service business in Florida. Um, Exterior cleaning on homes, roofs mostly, roofs, houses, windows, everything like that. Exterior pressure washing, window cleaning. It's really good in Florida because of the weather. The weather is real hot and what is it called? Humid, mildew. It grows really fast here. Houses can get out of control fast on algae. Morning. All right, guys, let's pump these numbers up. Come on. Let's get some shares on Twitter. Tag SoFi, Stock Twits. Let's pump these numbers up. We got 26 minutes. SoFi stock right now, as you guys can see, it's not doing anything. It's no pump at all. Like I've seen it up at this time period. It's like 2, 3, 4%. It's up 0.45. Like it's almost like the pre-market trading. They're not even letting. They're selling it off right now. They want people as less excited as possible. Look at the stock. You guys can see the stock on the thing, right? It's not even. It's up 0.30. It's nothing right now. 7. I believe it's coming. If things get out of control pretty fast, I mean, it could come pretty dang quick. I mean, less than a year, it's possible. Like once the stock makes its way, once the stock makes its way to 20, boom, a double's 40. Think about it like that. Let's go. Yeah, I think I put like, yeah, I think it could pump a lot today. It's possible. Let's go. Yeah, right now it's already at the like we already hit 100, I think. 100 degrees. I appreciate it, guys. I mean, I've been doing these videos for a while, and the channel, I don't know a word you could call it, uh, positivity. It hit the lowest in like 3 years again. These past 60 days from the tariffs. I mean, people were mad. I mean, I understand because of when you go from 18 and 9, yeah, the channel's been going through some crap because it's so SoFi focused. Making videos has been very rough. February, March, April. It's been tough. Let's just hope we can get out of this funk. Let's go. Let's go. Now, anybody new to the channel, you need to realize there's about, I don't know, maybe 15, maybe 20 analysts now covering SoFi. There's 20 analysts covering SoFi. Okay, listen to me real quick. There's 3 or 4 analysts, okay, right now. I promise you, SoFi could put up the exact same numbers as freaking Tesla did last quarter on revenue, profits, whatever. These guys already have 4 sell ratings ready to go right now. Like 4 sell ratings, they're already made, guys. These reports are already done. They already made them last night. It doesn't matter what the numbers are. Boom. That's just part of the game, okay? These 4 analysts are completely under some, competitors or short sellers control, and they're paying more money to have them be bearish than bullish. And these guys, the reports are already done. They're gonna drop immediately. Doesn't matter if SoFi reports a $300 million profit. These four guys, they'll never give up. They might take the stock up 50% on their price target, but these guys just every stock has their bears, and just like Tesla did. These four guys won't let it go. Okay, so just remember that if you see some nasty stuff come out, it was already made last night. Okay. Maybe I'm trying to keep them under control, not barking. I got a bunch of dogs. Let's go. Awesome. Holy crap, I made it to the bottom. That was the last I made it to the last comment. Look at that. See, I read every comment almost. All right, guys. 20 minutes. Um I'll ask you guys some questions. What are you most excited for this earnings than last earning? What are you most excited for? Are you crypto, members, profitability surprise, revenue, uh, customers per products around 1.45? What if that ticks up to 1.5? Well, what are you looking for? Let's hear it. Okay. Yeah. I'm not. I don't really. Yeah, I slept like a baby last night. And usually, I stay up all night just excited. My alarm went off, and I was like, I didn't even know why my alarm went off. I was like, why did my alarm just go off at this time? I'm like, oh, I got to do a live stream. Like, yeah, these these stocks or this stock is starting to feel pretty good tucked under your pillow at night. It's starting to feel like a real investment. With I think what's happening is the stock's just improving every quarter, and the stock's going like this, like it's just getting spring loaded. You know what I'm saying? Like when you do that for 3 years, it's gonna go, and it's never gonna come back. It's getting there. The scale is starting to get there, guys. So I'm excited. All right, let's see what you guys said. You guys are excited for. Yep. Yeah, that's what I'm talking about. That's a very good comment. That's really good. Oh God. Oh my God. Look at this. Look at this. I've been talking about this on Twitter every day. And look at that. I just forgot about that. SoFi Plus. What if they sign up 300,000 people on SoFi Plus? Something crazy. Stock needs to maintain over 25 or 20 smackaroos. Wow. Yep. Look at that. People are looking for that subscription service, $10 a month, seeing how it does. Loan platform expansion. What if we get another deal? What if they announce a deal freaking during earnings again? I mean, the market's pretty calm right now. Remember the last earnings, they announced a deal. We sold off 10-15%. What if they announce a deal today? Market's pretty calm right now. Dow futures up more than 150 points today, it says. Dow futures are up huge right now. How are other stocks? Yeah. There's like there's um there's 35 other stocks up more than SoFi in the pre-market right now. 35 other companies. So it's no pre-market hype. This is strange. Every stock's up higher than us. Everybody knows we got earnings right now. 35 other companies are up more than SoFi right now. Very interesting. Yes. 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 I'm hoping for one of the biggest jumps quarter over quarter. Maybe not the biggest, but third biggest, second biggest. I'm expecting a huge jump quarter over quarter, like massive jump. Like, and my revenue predictions still aren't at like 800 million. I'm not even that high. I'm in the sevens, 780, 790. Let's see. Crypto, man. This would be a good time for Noto to announce crypto. Galileo surprise. We know we got that hotel deal with Wyndham. Maybe there was another small deal that's about to go on to the revenue. So freaking think about our expectations right now for Galileo. Our expectations for Galileo out of 1 out of 10 are 2. That's our expectations for Galileo. 1 or 10. 1 out of 10 or 2 out of 10. No one even cares about Galileo anymore because the growth's been so bad. That's good. A profitability surprise. Sofi globalization. It's very cool. It's true. It's just weird stuff happens. Honestly, like weird stuff happens. Like we used to go up when we were a crappy company. We used to go up on earnings, and everybody used to play earnings. And now it's like the opposite. Now that we become a mature company, the stock sold off. But if you guys watched all my earnings, you would have saw that the Q3 was a blow, like because we got the loan platform business and the numbers were insane. And the stock sold off, I think 10%. And I told everybody, I said, hey, this thing is gonna freaking launch. I was like literally telling people, I promise you this stock is gonna launch because that Q3 it was way better than the Q4 just on bigger growth numbers and stuff like that. We were down 10%. The stock was at $10. I said it was going to launch because the numbers were crazy. So even though we sold off, the numbers were crazy. I said, watch. Boom. We went from 10 to 18. You see that? If we get another one of those, we may not even have to go through the crappy 10%, the fake pullback. We may not even have to see that. We could probably just go up another $8. So it just drops off weird stuff, usually guidance or something macro related. But that Q3 when we saw off 10%, I said, watch this. You go back and watch that earnings one day. We launched $8 after that nasty day. I knew that was gonna happen. So we may get another one. 15 minutes. Slowly upwards, suddenly rocket red countdown liftoff. Yeah, I really appreciate it. Thanks so much. $5. Appreciate it. Everybody download an account. I used to pump, member growth pretty good back in the day. Yes, exactly. The fundamentals are getting stronger and stronger. Exactly. It's coming. $18. $18 is coming pretty soon. Yep, that SP 500 is going to get us up about $10 easily, I think. Let's see. PayPal is up after. Are they right now? How much? PayPal's up 1.4%. European expansion. Quiet before this. That would be awesome. 11 million members. I see one of those analysts right now are just, you know what I'm saying? They're just ready to go. Might not be something they said before. Yeah, EPS, nobody even cares right now. We've already 4 cents, maybe. We might get 4. Yeah, I might join them. I might join them after the call or something like that, or we'll see. I haven't done that once. Yeah, usually guidance to be conservative and make sure the stock that doesn't get out of control. Cup and handle starting to move up. SP 500. 13 minutes. Burn them. Good financial. They did they have had good. I mean, Q3 was awesome. Q4 I just don't think was very awesome because the loan platform business stayed the exact same. You know what I mean? The loan platform business stayed the same quarter over quarter. So Q3 we jumped up revenue 90 million, and then Q4 we jumped up like 40, 50 million. You see what I'm saying? It's all about that quarter over quarter growth. Yeah, it hasn't yet. Look at that. It hasn't done anything yet. And SoFi right now it looks like it's frozen in time. It looks frozen in time right now. It's pretty crazy. 0.5%. Stock has to be over like $19 just to get eligible because of the market cap. It has to be over 11 minutes. Price target. What is everyone thinking? Notable sandbag, keep it neutral at best. Yeah, maybe. He's known for that. It doesn't even matter if you tell him to not sandbag. He still sandbags. It's crazy. I've wrote him so many times on Twitter. I said, if Noto stops sandbagging, we can go up. Next quarter, sandbag. Shit blows my mind. Maybe, yeah, we did report on a really bad day last quarter. We report on a nasty day, and now market's looking pretty relaxed right now. Market looks relaxed. Pivotal moment. Yeah, we were small. We're a big company now. Noto will speak around 8 a.m. about an hour after this release. Yeah, Cash Coach could get a lot of AI in that. Man, guys, this is gonna be a fun earnings. I think we're gonna get some really really good numbers. Like, do you guys understand how big TGL turned out to be? TGL turned out to be massive. I mean, there could be a chance every 3 out of 10 people in America know about SoFi now. You know what I'm saying? Like TGL was massive. It actually worked out. You could see TGL is planning on expanding like 3 to 4 new teams. The golfers, they got big money. Could be selling a lot of like mortgages to them, student loan refinancing. It turned out to be really good. We're getting some high quality members from TGL. High quality. I just think about who did all those people bank with prior to TGL, like with the people that were watching TGL. Like, think about who they had to leave to join SoFi if it was close to 900,000 people. Like, who were those golfers and golf fans with? Who did they bank with? You know, someone out there, market share is getting hit pretty hard by SoFi. You know. Yes. Crypto, member growth, SoFi Plus. That's it. They may, SoFi is very sneaky. I mean, they might not even release the SoFi subscription the way they don't release anything with Galileo. You know what I mean? Like, what if they don't even give us SoFi subscription service? It's possible, and tell us how many people are signed up. All right, guys, 8 minutes. 8 minutes. Birds are chirping outside. Birds are chirping. Y'all hear the birds? Y'all hear the birds? I hope he does. Market's not tanking. It's up. Everything's up right now. Don't be like that. All right, guys. 7 minutes. Come on. Hit the like button. Let's pump this video up to 1,000. Come on. 7 minutes. 7 minutes to go. You get the SoFi numbers. Come on, guys. You want to see the numbers? You got 7 minutes. Let's do this. It's just a wall. Okay. Birds are like 1 million members. Come on, 1 million members, SoFi. Subscription service, 300,000. 8 handle, 800 million on revenue. All right. Here we go. 6 minutes, guys. Come on. Pump us up. Pump us up to 1,000. 6 minutes. The numbers are about to be released. Here we go. I'm so excited. This is going to be so fun. Hopefully this stock just, you saw that new report with that guy from, what is it? JP Citizens. Dude was at 17 on his base case, $25 on his bull case. And he's like one of the best analysts in the world. He's on my Twitter right now. If you go look on did a little post about him. He's on there. The guy was ranked, he's ranked 14th in the world. We have the 14th best analyst in the world give us a bull case of $25. Why would the 14th best analyst in the world give us a $25 price target when there's other guys giving us 4? Why is there 3 guys giving us 4, 5s, and 6s, and then the best analyst in the freaking world, the top 15, $25? Kind of crazy, right? I'm glad he's covering the stock. 14th best analyst in the world, 25 smackaroos. Dang. No. I'm like a 9 o'clock guy, like 9 a.m. Not this early. Yeah, I feel confident. I slept like a baby last night, like a baby. How do you not sleep like a baby when we just got 2 back-to-back loan platform deals for like $10 billion, $8 to $10 billion. Like, how do you not sleep good at night? You don't even have a crypto launch yet. How do you sleep good at night? I mean, you sleep good at night. You don't even have a crypto launch. Crypto launch could come today. If not, when the stock goes higher, then they launch it next week, even better. A lot of things could happen today. Crypto launch, a loan platform deal, a Galileo deal closes. What if they close the top 10 bank today, guys? I haven't talked about that in a while. What if they close the top 10 bank? They've been trying to close these banks for 2 years straight. RFP stages for 2 years. They've been in RFP stages with top banks in the world. These banks haven't wanted to switch their cores yet and stuff like that, and they're going to start feeling the pain because SoFi, Chime, Robinhood are going to continue to take the market share. One of these big whales out there, SoFi has to close one, guys, and they've been really quiet lately. SoFi has been so quiet about these RFP stages with these banks. Like, we haven't heard a chirp in 6 months. This is it. 3 minutes, guys. 3 minutes. 3 minutes. Are you ready? Smash the like button. Let's do this. Drop a comment. 3 minutes. This is it. I'm going to be on the chat forum, looking on there. I got 2 computers up today, so I'm not playing around. I got the chat forum, and then I got the SoFi earnings news press on the website. So sometimes I get it in 1 minute. Sometimes it takes freaking 2.5 minutes. It just depends. So here we go, guys. Y'all ready? All right, here we go, guys. 3 minutes. 3 minutes. Y'all ready? Are y'all ready? 2 minutes. Once we get to 1 minute, I won't even be able to see what you guys are saying. I'm gonna be on the other page. Man, it just felt like I hopped on this live stream, and it felt like I've been talking for 10 seconds, and The earnings are here. It's just time is flying in space right now, guys. This is look the SoFi stock. Look at it. It's see what they do. See that? Look look at the stocks right now is red. It looks like the numbers are already terrible. They're tanking the stock right now. It's down 0.5%. It's crazy. Oh, Spotify just crashed. Oh, interesting. All right, guys, here we go. 2 minutes. People are cracking me up in the. All right, guys, 1 minute. Here we go. 1 minute. Y'all ready? This is it. It's game time. Let's do it. All right, guys, here we go. Any second now. The earnings are going to drop any second. Y'all ready? Y'all ready? Here we go. Come on. It's almost here. It's almost here. 6:59. 6:59. Come on, baby. Come on. Let's do it. Let's do it. 7 o'clock. 7 o'clock. There we go. 7 o'clock. We're here. Earnings should be dropping any second, guys. I'm on the SoFi news, events and presentations. Q4 is only out. It should be out right now. Here we go. Any second. Come on, man. This report right here says SoFi Business Wire. That says 774 million. Come on, man. What are we doing? I'm just trying to get the real presentation. Come on, man. Give me the cute one. It is 7:01. Are y'all on the website? The SoFi website? I'm on the SoFi website. What the heck? There we go. Finally. Okay. 771 million. That was a beat. 33% year-over-year growth. Record adjusted EBITDA 210 million. GAAP net income 71 million. Sets new record with 800,000 new members. 800,000 new members. Stock's up 4% right now. So it was a beat on everything. Revenue. Here we go. All right, can you guys see that? We're here right now. There we go. Can y'all see that? Triple B, it's going up. Okay, let me see. Okay, 771 million in revenue. Record EBITDA, that's what I'm talking about. Net income 70 million. That's pretty dang good for not worrying about profit at all. Tangible book value growth, $1 billion. Personal loan delinquencies declined by 9 basis points sequentially. Holy shit. That's good. Let's see if we got anything. Let's go shop digital finance. 800,000 new members, a new record. 210. Oh, wow, that's a lot. That's good on EBITDA. This thing. They increased okay, so guidance previously. What was guidance previously? Let's see how they increased their guidance. Let me see how they increased their guidance. Looks like they increased their guidance a lot. I got it right here. Okay, guys, so they went from 285. Wow. Wow. Listen to this. They went from 285 to 305. That was what they had previously. 285 million to 305 million. They jumped their profitability up 320 to 330. So they just went up 25 million on the top end for profitability, guys. That's an additional. That means EPS just went from 25 to 27 to, I can't see what it went to, but guys, they just jumped up profitability. Looks like 3 pennies, I think. Maybe 2 pennies. 2 to 3 pennies they just upped their EPS by. Wow. They just upped their revenue to they just jumped their revenue up $35 million full year right here. Look at this. This 3.310. They were at 2.275. So they increased their net income by 25 million. The revenue by yeah, that was really good. Stock should be up. Stock's up 2%. 2% right now. So they increased everything across the board to start out the year. Wow. Okay, hang on. I mean, I gotta look and see if we're fee-based revenue of $315 million, 67% year over year. Wow. Let's see. Let me go to stock Twitter. All right. Did they close? I'm gonna go to the comments, see what you guys are saying. It didn't crash. It's down 1%. Hang on, let me pull it. I'll pull the stock up for you guys first. It didn't crash. It's down 1%. It's not even down 1%. Let me see. It's not even down 1%. Don't be fooled. Okay, I want to see if we got any. Did we get any? Let me see if we got any deals. I want to read your comments. Did you guys see anything Galileo deal related? Anything? No. That's it. I'm looking. Loan platform business is still only personal loans. Wow. Student loans hit a new record. Home loans hit the highest record in 4 quarters. So the new record for student loans, 1.1 billion, and then personal loans hit a new record. Ooh, loan platform business, guys. Listen to this. Loan platform business, we're at 1.1 billion last quarter, loan platform business. Now we're at 1.559 billion. So they're already at $1.5 billion now on the loan platform business. Page 16. Ooh, let me show you guys that real quick. Hang on, let me show you this real quick. Look at this new slide they have. This slide is very nice. Look at this. Okay, check this out. This is a new slide they're doing, guys. This thing is nice. Can you guys see that? Maybe I'll make it a little bigger. No. Okay, real quick. Look at this right here. So let me see. Right here, look. So this number right here, the gray, is the loan platform business originations on personal loans, and it was $1 billion the last quarter. So look at that. It's at 1.5 billion right now. So it went up 500 million quarter over quarter. And then look at this. Student loans hit a new record. Home loans, highest record in 4 quarters, it looks like. So, yeah, really good. Stocks playing a lot of games. It just went green, red, green. I haven't seen that in a while either. I haven't seen a green, red, green either. Flat. Profit. Time to buy in. Let me see. Anything on the subscription service? Anybody see anything on that? Anything? Oh, they ticked their EBITDA up from 865 to 895. Oh wow, looks like they gave us the Q2 numbers. It looks like they beat. Wow, the Q2 guidance is strong, guys. It's the Q2 guidance is. Let me show you guys this. Now that I really saw all the presentation. Look at this. Look at this, guys. Remember I made that video everybody was crying about where I said Q2's nightmare. Look at this, guys. Q2 right here. Look at this. 785 to 805. 35% growth on the high end. Adjusted EBITDA 210 on the high end. That's a new record. Net income's now up to 60 to 70 million. 6 cents EPS on the Q2 guidance. They're finally starting to break out of this crappy 3, 4, 5 cent EPS range. We might get like 8 cents next quarter. Looks like they're finally, yeah, look at this. Every number, look at this right here. Look at this, guys. Come on. Look at this. 305 to 330 net income increase. Adjusted EBITDA 865 to 895. Revenue 3.275 to 3.3. Diluted EPS, they ticked up 20. I thought it was 2 pennies. Yeah, it went up to 28. Tangible book value growth 575 to 600. I mean, everything went up. Q2 looks really strong. Look at this, guys. 785 to 805. Pretty dang good. I'm trying to find subscription service now. What are you guys saying? Good morning. Good morning. Let me see. Calls at 8 a.m. Crypto. Yeah, we need some crypto news right now. Guys, listen to this. The financial services, it grew from 256 million to 303 million. It went up 47 million quarter over quarter. Almost 50 million quarter over quarter on financial services. The contribution profit was 148 million dollars. Wow. Wow. Total originations was almost flat quarter over quarter. That's good. Wow. Looks like they're trying to sell this fee-based story, guys. This fee-based story, because that's crazy. 50 million quarter over quarter financial services, loan platform business, 1.5 billion. Wow. Um, let's see how the deposits are. Deposits 27.2 last quarter. 27.2 deposits look kind of. $27.2. Deposits grew 1.2 billion. Looks like they don't even need deposits anymore. Well, loan platform business that grew from 1 billion to 1.5 billion quarter over quarter. That's pretty dang good. Fee-based revenue mix 41% of revenue. One annualized 1.2. 0.6. Anything crypto or no? No crypto? I'm looking for. He's talking about commercial. That was at 7-Eleven. He probably already talked. That was 6 minutes ago. Strong. Well, it looks like I missed it because I don't even have CNBC up. Yeah, tech flat, $2 million quarter over quarter. on CBC. Crypto news. 4 minutes. Well, I don't have. Did he say anything? Crypto? Is it coming back? Crypto is back. He's on CNBC. Let me see. They got it. I don't know. In Florida, you try to pull it up on here, and they block it or something. No. Sorry. 6 months. Crypto back. We get the earnings call. Okay. All right. Looks like crypto's still taking some time to get the actual revenue on the thing. All right, guys. What did you guys, what were you most excited about? What were you guys most excited about? We had record EBITDA and record revenue and record members. Record members, record EBITDA, record revenue. That's what we got. We got those 3 records. Loan platform business, new record, 1.5 billion in a quarter. What do you guys think? This is how Sofi is. People get so excited and then they don't see like phenomenal blowout, unbelievable numbers. Yep. EBITDA record. Delinquencies going down. Record 772 million revenue. Record members. Record products. Net income. Not bad. 71 million. So we're about to get to 100 million in net income, and we're not even focusing on net income, guys. They're starting to just print money without even trying to print money. I would love to have seen a little bit more members. I would have loved to see a 900, 800. TGL got us 800,000 members. We used to put up 400, 500,000 members a quarter. We were putting up 400 and 500. Now we're hitting 800. Fee-based revenue. He increased guidance. I don't know. People want the world. I mean, Jesus. Oh. Did we lose connection for a second? I think we lost connection. No? Can you guys still hear me? No? Can you guys hear me? My audio still there? Okay. Well, let's see how everything else is doing. SoFi's up 2.7. PayPal's PayPal's red, Lending Club's red, and Spotify is down 8.5. Well, hey, he increased. Hey, he increased guidance. I mean, what else? I don't know really know what else he can do if he increased guidance. Macro. We'll see. We are gonna see. Loan platform, $1.5 billion. They went up 500 million quarter over quarter. That's awesome. It looks like Q2 is going to be extremely strong. We're going to be over 800 million. Net income. What if net income could be like $400 million this year, guys? I mean, if they increase 2-3 more times, net income is going to be about 400 million if they jump it up another 30. Look at this. All our records. Yeah. I'm pretty happy. I mean, this is a good quarter. It says on the CNBC article, it says like they're talking about how they got the consumer has strength for SoFi. When you see defaults go down quarter over quarter heading into this Q2, I mean, come on. I mean, it's fee-based revenues up, loan platforms up, record members. All right, guys. I mean, the only thing that I'm seeing is like, of course, tech platform is down 2 million, but like I said, we had our anticipations were 1 out of 10 on tech platform. It's all about deals, you know. The tech platform has really nothing to do with SoFi. These companies out there, these banks, they don't want to switch over yet, and you know, they'd rather just see a market share slip by. So the tech platform, we knew that was coming. That's I don't know. I already knew that was gonna be flat. The only thing, you know, I just would have loved to see a little more member growth because now I'm seeing how hard it's gonna be to get to 1 million members. Like now you guys are seeing how hard 1 million members truly is. I mean, it is freaking hard, right? To get to that 1 million mark. I mean, I thought we were going to be closer to 900,000. We hit 800,000. SoFi just, yeah, they got to just put the foot on the gas for this NBA season right here. The whole playoffs for the next 2 months and try to get as close to that 1 million as possible. But you guys can see, 800 million or 800,000 it is. I'm liking the net income. I'm liking that net income increase, guys. Think about it. We're already increasing our net income this early. All right, I'm gonna tweet that. Previous. All right, posted it on my if you go on my Twitter, it's right there, nice and clean. Take a look at the Twitter. It's right there. You'll see it on my Twitter, guys. It's 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 very clean, as you guys can see. How does that look? That's only Q1. It looks like SoFi for a year that they're not worried about profitability. They could get to 400 million bucks profitability. That's a clean post, guys. That is clean. I'm liking that. I mean, that's what got me excited when I saw that. I was like, dang, man, that's not bad at all. Yeah, guys, fee-based revenue. I'm about to do another post. I'm about to do another post right now. Watch this. I'm gonna start doing my pumping for you guys. Watch this. I got us right here with the pump, pump, pump. All right, watch this. I got something for you guys. I got something for you guys right here. Well, we're looking pretty good, guys. All right, take a look at that post on Twitter. Look at that post I just put out. Shit is clean, boy. Clean. Look at that. Y'all see that? Y'all see that? Y'all see that post? Y'all see those two back-to-back posts I just put out? Now y'all starting to see how clean this earnings really was. Y'all see how clean this earnings really was? It's looking clean now, huh? Yeah. Net income. It's only Q1. We're already ticking up to 330. Loan platform originations fee base just scaled to 1.55 billion. Dang. About to hit 14. I try to tell you, once you really look at these numbers, I mean, they're doing exactly what they said they were going to do. They're going to fee-based revenue. They're scaling growth. Profitability is still going up. I'm telling you guys, this could be an insane year. About 3, 4 more quarters. This thing's going to be a giant. Man, we're looking good, guys. What, Hims reported earnings today? I didn't know they reported earnings. Huh. Guys, look at SoFi. Come on now. SoFi's look at what why are we worried about him? Look at SoFi. SoFi's moving up. Gotta get it $20. $20. Guys, I'm telling you, look at my Twitter. That's all you need to see. This is only Q1. They just ticked up net income to 330. Loan platform just scaled by another $500 million quarter over quarter. Loan platform up 500 million quarter over quarter. Net income up 25. They did everything. They increased Q2. They increased full year profitability, EBITDA, fee-based revenue. The only thing we don't have right now, two things we don't have now. We don't have the whales for the top 10 banks, and we don't have crypto. That's it. If we get those two things, this thing's gone, never coming back. Two things out of our control. The banks landing the bank deals out of our control has to do with the banks. Crypto out of our control. Everything's out of SoFi's control. Whatever is in SoFi's control, they're making it happen. Things we could have. I wish we could have got better. I wish we could have saw a little bit more members. But man, I mean, the net income profitability is also awesome. I'm really liking the net income profitability as well. Supposedly 6 months, something like that, like 6 months. Guys, I promise you, I'm seeing is 2 billion, 2 billion probably on loan platform. 2 billion loan platform business next quarter. Easily 2 billion. With all these deals they're closing, they're gonna hit 2 billion next quarter on loan platforms. And you're gonna see financial services is gonna grow bigger than lending pretty soon. I mean, whoa. Oh my God, I need to put that post out. That's a good post to put out. Hang on 1 second. That's a good post to put out. on, where is it at? Where is it at? Stock-based compensation was down $3 million quarter over quarter. Stock-based compensation went down. They're dropping their stock-based compensation $3 million. That's good. Defaults are down. Jesus, man. Book value 6.7 billion. This is great, man. Where's fee-based revenue? All right, I got a 238. I got another post for you guys, okay? Watch it. Watch this post I'm about to put out, okay? Watch this post I'm about to put out for you guys. This is a good one right here. All right, I just put out a new post. Another one, financial service revenue. Look at that. Crazy jump. Crazy jump. All righty. Upstarts up 2.6. Sofi up 5. Okay. Dude, come on. Well, solid. I mean, look at the y'all see that? They're at oh man, you know what? They're if you look at the guidance on that, they're lying on that guidance, guys. Look at this. On that page. Oh, they're lying on that. That guidance is gonna be crazy. Oh yeah. Mm-mm. Well, it looks like financial services is at 1.2 billion and it's growing 50 million a quarter. That's probably going to be at 1.3 billion by the end of this year. Earnings call in 16 minutes. 16 minutes, guys. Oh my god, you guys are freaking out about Hems. Jesus. They signed a deal? Long-term collaboration with Novo. Weight loss treatment. All right, that's it. Strong earnings, strong everything, records across the board. So we were down 5%. People would be upset, and now we're up about 5%. It seems like people are still upset. Part of the game, guys. Part of the game. The full year guidance. Full year guidance was good. The guidance, they went up. The profitability went up. The EBITDA went up. The revenue went up. Everything went up, and it's only Q1. They're going to do it 3 more times. Personal loan delinquencies declined 9 basis points sequentially. Net charge-offs declined 6 basis points to 3.3. I don't know. I just know that the revenue was flat. It's crazy if the revenue was flat and they lost members. That means the members are worth $0 basically. Hey, Noto could announce a loan platform deal for all we know. That'd be crazy if he announced a loan platform deal on the earnings call. Be pretty insane. Let's find out. Yeah, I'm really happy though. This is good. Net interest margin is holy crap. Not yet. Not yet. Not yet. Not yet. Their net interest margin is going up to 6%. It's still going up. It's going up to 6%, and they're adding 800,000 members a quarter. Net income's going up. Stock-based compensation's down. Contribution margin, lending's exactly the same quarter over quarter. Wow. This is awesome, man. Do you guys understand? Like, do you guys have any idea how much profit SoFi would have if they decided to add like let's say 600,000 members or 500,000 members a quarter? Do you know how much more profit we would have? It would be insane. Dude, you are, oh my God. You are so annoying. What the hell? Jesus, this person has said hymns 25 times. Oh my God. Jesus. I mean, okay, they closed the deal. It's up. It was $70 2 months ago. Now it's 37. Okay? Jesus. What is going on? Where's the earnings call? 10 minutes? Just get to the earnings call. Oh my goodness. Let's see. Any price targets yet? Any price targets? No, he didn't. It's just annoying. He's when you comment 7 times in a row, it's like, okay, I see it. Well, I mean, I literally looked at every. Oh my God, something's wrong with people today. Something's wrong with people today. You see how much people are like worried about their investment? They have to say it 1,000 times to like try and pump it. All right, guys. 9 minutes. We can hear the call. I really think they're gonna announce something because think about it, they haven't announced anything on the press releases, on the earnings. I didn't see anything related to Galileo. I didn't see anything. No, I don't. I just quick access pre-market trading. I just popped it up for the Robinhood. I'm just ready for this earnings call. I think we're gonna get something exciting. We're gonna get something exciting. I mean, guys, think about it. The stock was $18 6 months ago in Q3. $18, and the numbers were nowhere near as good as this. I mean, we were putting up 670 million, and people were paying 18 a share at 600 million in revenue. 18 a share, 700,000 members a quarter. Loan platform, what was that, $1 billion? It's already like Q2 is going to be a big quarter. If they get to 2 billion on loan platform, sign a couple more deals, crypto comes back, I think we're going to see $25 pretty soon. This is a strong quarter, man. Strong quarter. We just got to wait and see what these analysts are talking about. Okay, all right, I'm going to read the press releases. Holy crap. SoFi's got Oh my god, dude. SoFi's got 20 press releases right now, like for Dow Jones, Benzega, Dow Jones, Motley Fool. All right, let's see what it says. Ready? To see what the market is saying because it was so bad last quarter. Remember, they guidance soft, whatever. So if I raises full year 2025 EPS, okay. So if I see Q2 net income 60 to 70 million, SoFi raises full year, SoFi guidance boost, SoFi Q1 profit revenue up 2025 guidance boosted. Do you guys hear this? SoFi's members and products rise 34% year over year. Financial services revenue doubles. I mean, this is insane. This is good. Net income $71 million. Oh, I like that. Profitable every quarter. Profitability is going up without even worrying about profitability. My God. All right, 5 minutes. Here we go, 5 minutes. 5 minutes. Let's see if Noto pulls a rabbit out. He might pull a rabbit out. It's possible. Let's see if we get a rabbit. Something. What if they announce the deal we got from last quarter with what if we get that deal back from the Galileo deal that they said they closed, they never announced it. Oh god. Let's see the comments. They're launching crypto. Want to offer crypto and blockchain. Oh my god. All right, guys. HIMS is exploding. Don't buy it today. You should have bought it yesterday. Okay. Yesterday was the time to buy HIMS, not today. Don't buy up 50%. Yesterday was a good buy. Don't chase that. Okay. Don't buy up 43% on any stock. Never do that. I really want to see what these analysts say about SoFi. I just want to see how they react. I want to see if some of the 20 guys go to 25, maybe 22, 25. I want to see if they go up $2 to $5. Um, I don't know, guys. This is. I mean, I don't think Noto put anything on this thing for press releases. Maybe we get a press release, but it's just crazy how like, isn't it crazy how SoFi is saying we're not focused on profitability. We're trying to just get as many members, right? So they're saying they're not worried about profitability, but their profitability is going up without even trying now. It's last quarter it was 60 million, now it's at 70 million, 800,000 new members, more loan platform deals. I don't know. It's looking good. Options for selling options that could be coming pretty soon. Man, it's just crazy. Like record student loans, 4-quarter record for home loans, record for personal loans, 1.2 trillion credit card debt. They're saying, God, they might be able to scale this loan platform business forever. They might be able to scale for the next 5 years, like easy. All right, let's see this call. Here we go. 1 minute. Let's see what we got. Earnings call is starting. Earnings call is about to start. Let's see what I mean. Let's see what people are saying on the. Yes, 1 minute. 1 minute. The call. The 1 minute the call should start. One more minute. Stock's going bananas right now. It's going up 6%, down 1%. My God, you see that shit is crazy. Uh,
between Fortress and Edge Focus. These additional deals will accelerate the quarterly originations well above the current level of $1.6 billion. Importantly, the LPV loans do not present any ongoing credit risk and contribute to member growth as we hold the relationship and can benefit from cross-buy into other SoFi products. So far, the vast majority of our LPV loans have been within our prime credit box, but over and above the volume we want to put on our balance sheet. However, we have the ability to also meet demand from buyers who want near prime loans with higher WAC. We can even extend this program to other loan types in the future. We are incredibly optimistic about the depth and breadth of the growth opportunities in the loan platform business, and we see it becoming our third billion-dollar revenue business. Turning to SoFi Invest. In January, we shared that we are accelerating our investment in SoFi Invest, and that decision is already bearing fruit. Q1 2025 marked an acceleration in product growth to 2.7 million products, up 21% year over year, and we expect further acceleration in Invest product growth throughout the year. The first quarter also marked our best quarter ever of member engagement, even compared to when we offered cryptocurrency or launched IPOs and alternative assets. In the first quarter, we made significant improvements to our single stock presentations, which provide members with insights to help make more informed investment decisions. Our new experience is clearer, easier to navigate, and more informative, driving positive feedback and, importantly, an increase in engagement. We also made it easier to roll over 401k assets with a more intuitive design and stronger back-end engineering, which improves completion rates and provides another great way to build long-term, durable relationships with members. We continue to expand on our unmatched selection, including investment opportunities that have been typically reserved for the high net wealth segment. Following our highly successful SPV for SpaceX last year, we've expanded our partnership with Templum so members can invest in another privately held company, Anthropic. We're also accelerating our product investment to improve the Invest user experience and drive more personalization, as well as better discovery of our Invest product offerings within our app. We want to ensure that members are aware of all we have to offer and are getting valuable insights and information that are tailored to their specific needs. The more we surface our great investment selection, the more engagement we see. So Invest stands alone in the breadth of our offering, including the ability to buy and sell single stocks without commissions or fees. Our award-winning robo-advisory product that offers 3 different themes with a total of 15 unique strategies. 4 SoFi-branded ETFs that are specifically tailored to our members' needs, IPOs, and level 2 options. We are also providing access to alternative assets, including private equity, private credit, private real estate, venture capital, long-short hedge funds, and private individual company investments. We continue to add more selection, and by the end of the year, if all goes as planned, we will add both level 1 options and certain crypto or blockchain offerings. Given the evolving regulatory landscape, we see an opportunity to re-enter the crypto and blockchain business more comprehensively. In addition to enabling members to invest in crypto coins, we will enter other areas over the next 6 to 24 months, but potentially much sooner via acquisition or if the changing regulatory landscape allows. Our aspirations over time are as broad and deep as they are for our existing SoFi business, including developing crypto and blockchain offerings across borrowing, investing, paying, saving, and our technology platform services for third parties. Turning to our tech platform segment. Here, the market for digitally native financial product platform is significant and continues to evolve. Recognizing the longer lead times associated with large-scale core banking conversions and consolidation among smaller fintech clients, we found innovative ways to broaden our client base. For example, this quarter, we launched a first-of-its-kind reward debit program with Wyndham Hotels and Resorts. Later this year, we expect to launch similar co-brand debit card programs with other travel and hospitality companies, further expanding our footprint among consumer brands. And we recently signed a deal with Mercantile Banco, which offers personal and business banking services in Panama, and will use our Cyberbank digital banking platform. We are pleased with the demand from new client opportunities for the tech platform business and expect these wins and others in the RFP process to have an impact on our revenue in 2026 and beyond. Now turning to our lending segment, starting with our home loans business. Our 2023 acquisition of Wyndham Mortgage strengthened our technology and fulfillment capabilities, creating significant capacity for growth. In Q1, this helped us grow home loan originations by 54%. At the same time, we've expanded to offer home equity loans, a great value to members given the fact that they are sitting on low-rate mortgages that they do not want to touch in a higher rate environment. This product, which we didn't have a year ago, accounted for more than 1/3 of our home lending volume during the first quarter. It was our best quarter ever for home equity originations and should only go higher from here. As interest rates come down, we expect in our planning for a significant acceleration in the demand for home loans for both home purchase and refinance. We're also launching new personal loan and student loan refinancing products. The new personal loan product launching next month will be for prime credit card customers that carry a revolving balance and are making mostly interest-only payments. These are commonly referred to as revolvers. Members will now get a fairly priced deal instead of being gouged by credit card companies and big banks who charge 20+% interest to earn an ROE of 50% on some of these prime credit revolvers. We will meaningfully cut the cost of debt for this prime borrower, reducing monthly payments by as much as 40%, while generating an attractive target ROE in line with the 30% that we generate on our broader personal loan portfolio. So all you premium credit card holders out there that somehow found yourself with $10,000 to $30,000 or more of debt on your credit card that you're now only making minimum payments on, we are here to help get rid of that debt and get your money right. In the midst of uncertainty around student loan options in the market, we just launched an innovative member-centric refinancing solution known as Smart Start. This allows for lower payments in the early part of the loan and steps up into paying regular payments after this introductory period, helping members find their footing and build long-term savings. Yet another way we innovate to help our members spend less than they make and invest the rest. Let me wrap up the discussion on our results, branding, and product innovation with a perspective on SoFi Relay and SoFi Plus. Both products make their footprint bigger than their foot and are critical elements of our financial services productivity loop. SoFi Relay allows members to easily track and manage all their SoFi and non-SoFi financial products and accounts on our digital platform through an easy-to-use dashboard. Relay is our second largest product at $5 million, which is up 41% year over year. Although Relay doesn't generate revenue directly, it is a lightweight starting point and serves as the tip of the sword with very attractive cross-buy patterns into other SoFi products. As an example of Relay's impact, 1/3 of the Relay First members that cross-buy adopt at least 3 products, with the most common sequence being Relay to Money to Invest. Turning to SoFi Plus, our premium membership tier that brings together the best of all we have to offer through America's most rewarding financial membership, unlocking over $1,000 in value each year. Previously, members needed a direct deposit with us to be a SoFi Plus member, but during the first quarter, we added a fee-based subscription option as well. While this option is new, we are already seeing some promising behaviors among early subscribers. Nearly 90% of the new Plus members were already existing members, demonstrating the validation of making this product more accessible via a pay option, not just via direct deposit. The product has also been a catalyst for our FSPL, driving the second order effects of cross-buy among these members, with nearly 30% adopting an additional product within 30 days of enrollment. Among SoFi Plus subscribers who are completely new to SoFi, over 75% adopt at least a second product, and over 40% adopt a third product within 30 days of enrollment. Importantly, these members are adopting products across our platform beyond just SoFi Money. This data demonstrates that members truly value the one-stop shop model, and by exposing members to our complete offering, we can accelerate cross-buy. Hopefully, it is as clear to you as it is to me that our strategy continues to deliver great results. That is why we have decided to further accelerate our rate of innovation while still being able to increase our full-year guidance. Our value proposition has never been more relevant to the members and clients we serve. We are stepping on the gas to launch new products faster and iterate to improve our existing products at an even more rapid pace. The opportunity in front of us is too massive to risk underinvesting to capture it. I'll be back after Chris covers the detailed financial results and guidance to spend a few more minutes talking about this important topic and the strength of our competitive position.
Thank you, Anthony. It has been a strong start to the year as we continue to drive durable growth and strong returns. We exceeded each metric that we guided to during our last call, on the way to delivering accelerating revenue growth and our sixth consecutive profitable quarter. For the quarter, revenue grew 33% year over year to a record $771 million. Adjusted EBITDA was also a record at $210 million and a margin of 27%. Net income was $71 million at a margin of 9%, and earnings per share was 6 cents. This included a small benefit of about a penny related to a lower than expected effective tax rate. An important driver of the acceleration of growth was the increased contribution from capital-light non-lending as well as fee-based revenue sources. Our non-lending businesses generated $407 million of revenue, up 66% year over year, and we also generated record fee-based revenue across all businesses of $315 million, up 67% year over year. Turning now to our segment performance. In terms of financial services, for the first quarter, net revenue was $303 million, more than double that of Q1 2024. Contribution profit was $148 million, up 4x from last year. Contribution margin was 49%, almost double what it was last year. Net interest income for this segment was $173 million, up 45% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 3.2x to $130 million in the quarter, which equates to over $500 million in high-quality fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Financial services revenue per product increased from $59 in the first quarter of 24 to $88 in the first quarter of 25. That's up nearly 50%, and we see continued upside as newer products mature. In Q1, our loan platform business generated $96 million in adjusted net revenue, up 44% from just last quarter. Of this, $93 million was driven by the $1.6 billion of personal loans originated on behalf of third parties, as well as referrals. I would note that these originations were up 41% quarter over quarter, while the associated platform fees increased approximately 50%, reflecting stronger monetization within this business. Additionally, LPB generated $3 million from servicing cash flow, which is recorded in our lending segment. The growth opportunity for this business continues to be strong. On the heels of launching our $5 billion partnership with Blue Owl Capital in Q1, we are pleased to have recently secured an additional $3.2 billion through a one-year, $2 billion extension with Fortress and a two-year, $1.2 billion agreement with a joint venture between Fortress and Edge Focus. These partnerships continue to demonstrate the attractiveness of our loan production to investors. In addition to our LPB revenue, we continue to see healthy growth in interchange, up 90% year over year, driven by close to $16 billion in total annualized spend in the quarter across money and credit card. Shifting to our tech platform. For the first quarter, we delivered net revenue of $103 million, up 10% year over year. Contribution profit was $31 million at a contribution margin of 30%. Revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. We saw a slight decrease in accounts to 158 million, or 6% year over year, while revenue still grew 10% year over year, with similar growth in potential acceleration in Q2. This was driven by a large client's decision last year to diversify their processing providers, which was factored into our outlook for 2025. We continue to diversify our client base by winning new business, and we expect these wins to drive financial performance and an offset in 2026. Turning now to our lending segment. For the first quarter, adjusted net revenue was $412 million, up 27% from the same period last year. Contribution profit was $239 million, with a 58% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 35% year-over-year to $361 million. During the last quarter, we had record total loan originations of $7.2 billion, up 66% year-over-year. Personal loan originations were a record at $5.5 billion, of which $1.6 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 69% year-over-year. Student loan originations were $1.2 billion, up 59% from the same period last year. Home loan originations were $518 million, a 54% year-over-year increase. Capital markets activity was very strong in the first quarter. We sold and transferred through our loan platform business $3.1 billion of personal and home loans. In terms of personal loans, we closed $1.1 billion of sales in whole loan form at a blended execution of 106.2%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we had held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $322 million at a blended execution of 102.1%. In addition to our personal and home loan sales, we executed a $698 million securitization of loans originated through our loan platform business. This was the first securitization of new collateral in our Sofi Consumer Loan Program, or SCLP, since 2021, and the first using collateral originated in the loan platform business. Importantly, this channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds levels with a weighted average spread of 87 basis points and an all-in yield of 5.10%. Turning to credit performance, the health of our consumer remains strong. Despite the market volatility, we are not seeing signs of weakness. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 743, while our student loan borrowers have a weighted average income of $134,000 with a weighted average FICO score of 769. Our credit trends continue to be strong after seeing delinquencies peak 1 year ago in the first quarter of 2024. For personal loans, the on-balance sheet 90-day delinquency rate was 46 basis points in the quarter, a decrease of 9 basis points sequentially. The annualized charge-off rate also declined to 3.31% versus 3.37% in the prior quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.8% versus 4.9% last quarter. For student loans, the on-balance sheet 90-day delinquency rate was in line with last quarter at 13 basis points, while our annualized charge-off rate decreased 15 basis points to 47 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originated from Q4 2022 to Q2 2024 have net cumulative losses of 4.09%, with 43% unpaid principal balance remaining. This is well below the 5.53% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by a more favorable 16 basis points after widening improvements of 15 basis points in Q4. Additionally, looking at our Q1 2020 through Q4 2024 originations, 59% of principal has already been paid down, with 6.7% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 41% of unpaid principal would need to be approximately 10%. This would be well above past levels, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the first quarter, our personal loans were marked at 105.5%, up 55 basis points from the end of the prior quarter. This change was primarily a function of the discount rate decreasing by 42 basis points to 4.87% due to the underlying benchmark rate decreasing by 34 basis points and spreads tightening by 8 basis points. As we've previously noted, both of these changes are empirical, based on actual market data, not assumptions. Additionally, any fair value impacts that resulted from interest rates increasing were offset nearly 1-for-1 by hedge losses. Additionally, the annual default rate decreased by 18 basis points. Slightly offsetting these impacts was a 14 basis point decrease in the weighted average coupon and a 52 basis point increase in our conditional prepayment rate. When a borrower prepays, we are still capturing the principal, and the impact to the value of the asset is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. At the end of the first quarter, our student loans were marked at 105.2%, up 107 basis points from the end of the prior quarter. This change was a function of the discount rate decreasing by 18 basis points to 4.22%, driven by the underlying benchmark rate decreasing by 38 basis points, partially offset by 20 basis points of spread widening, and a 10 basis point increase in the weighted average coupon. There were no material changes to the annual default rate or the conditional prepayment rate. Turning to our balance sheet. In the first quarter, total assets grew by $1.5 billion, driven by $1.6 billion of loan growth and approximately $265 million of growth in cash equivalents, and investment securities, partially offset by a reduction in other assets. Total company-wide cash at quarter end was $2.7 billion. On the liability side, member deposits grew by $2.2 billion for the quarter, bringing total deposits to over $27 billion. Net interest margin was 6.01% for the quarter, up 10 basis points sequentially, reflecting our ability to sustain healthy deposit versus lending betas. This included a 27 basis point decrease in cost of funds, which was partially offset by a 13 basis point decrease in average yields. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we remain very well capitalized. Our total capital ratio of 15.5% at quarter end remains comfortably above the regulatory minimum of 10.5%. Tangible book value grew more than $167 million sequentially to $5.1 billion, and tangible book value per share at quarter end is $4.58, up from $3.90 a year ago. Let me finish by providing our revised outlook for 2025. Given our strong start to the year, we continue to expect to add over 2.8 million members, which represents at least 28% year-over-year growth. We now expect adjusted net revenue of $3.235 to $3.310 billion, above our prior guidance of $3.2 to $3.275 billion. This equates to year-over-year growth of approximately 24 to 27%, an increase from our prior guide of 23 to 26%. We now expect an adjusted EBITDA of $875 to $895 million, above our prior guidance of $845 to $865 million. This represents a 27% margin. We now expect adjusted net income in the range of $320 to $330 million, above our prior guidance of $285 to $305 million. An adjusted EPS of 27 to 28 cents, above our prior guidance of 25 to 27 cents. We now expect growth in tangible book value of $585 to $600 million for the year, above our prior guidance of $550 to $575 million. For the second quarter of 2025, assuming credit spreads are in line with the range we've observed year to date, we expect to deliver adjusted net revenue of $785 to $805 million, adjusted EBITDA of $200 to $210 million, adjusted net income of $60 to $70 million, and adjusted EPS of 5 to 6 cents. Overall, it's been a strong start to 2025, and we're looking forward to a great year overall. I'll hand it back to Anthony to wrap us up and kick off the Q&A.
Thank you, Chris. As I mentioned, our strategy and execution continue to deliver excellent results. The opportunity in front of us remains massive, and we are accelerating our investment in new product launches. We are building from a position of strength as the only digital company to successfully scale members and revenue across 5 lending businesses, a world-class SoFi Money offering with $27 billion in total deposits, and invest in credit card offerings with 2.7 million products and over 300,000 cardholders, respectively. At the same time, we're incubating and beginning to scale our SoFi Protect offering across home, auto, and life insurance, lending and checking products for small and medium businesses, and of course, our recently launched SoFi Plus product with the best value in a financial services subscription offering. Additionally, we've seen tremendous scale and indirect value creation from SoFi Relay with over 5.1 million products. Despite all of that success, we built an entirely new loan platform business in less than 12 months, generating a $380 million annualized high-margin fee revenue stream. And of course, our technology platform business serving over 158 million accounts and over 8 billion annualized transactions while helping power the SoFi products. Make no mistake, within each business, we have or will have superior speed, capabilities, and services when compared side by side to alternative offerings, as product quality is critical to being a member-centric company. But having great products is not enough. We must also have a sustainable competitive advantage. In that regard, we believe our unique strategy, the combination of our businesses, and how we have architected our products results in building a sustainable competitive advantage and having the highest lifetime value per member. Our highest lifetime value is built on the back of striving to have superior unit economics on a per-product basis, combined with significantly lower cost and more products and revenue per member, such that we can provide more value in each product and more value when they are used together. And we can do this better than anyone else. Specifically, our competitive advantage allows us to offer superior and even one day unmatchable value to our members in the broadest selection of loans with the best interest rates, superior APY and deposits, the best value in a financial service subscription product in SoFi Plus, the broadest selection in invest products and competitive matches on invest rollovers, a fully comprehensive suite of products all in one device, which is necessary to get your money right, as well as SoFi Rewards across all of our products and services, free financial planning with the CFP, discounted travel offerings, and other spend better offers. Additionally, we provide free services like Relay, Autopilot, Vault, Zelle, and P2P. And finally, several new AI-driven products in development that will specifically show our members how to get their money right by spending less than they make and investing the rest, like the SoFi Expense R and SoFi Cash Coach, just to name a few. In total, SoFi's unmatched value across its products and services make it the best place to help members achieve the most critical factors in their financial life, which is how to spend less than they make and invest the rest in order to get their money right and realize their ambitions. All that we do must serve this simple but hard to achieve equation better than anyone else. Hopefully, our leadership position as a one-stop shop in our competitive advantage with the highest lifetime value is clear, as well as why we want to accelerate our rate of investment and innovation to take advantage of the incredible competitive position we have built. In my mind, our path to our ambition is simple. Given the superior competitive position we occupy, the only thing that stands in the way of us and our aspirations is, well, us, and our ability to maintain a founder's mentality culture to further strengthen our competitive sustainable advantage. With that, let's begin the Q&A.
Thank you. At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Andrew Jeffrey of William Blair. Andrew, your line is open. Please go ahead.
Hi, thank you very much. I appreciate you taking the question. Terrific results here. Anthony, I know it might be a little bit of a difficult question to answer, but as I look at the very impressive performance of the loan platform business, can you envision a time where SoFi is just materially a fee-based business? And what are the implications for that for deposits, which also for different interest rate environments? I just wonder, do you wind up with excess funding and do you grow loans faster? Primarily on the platform fee.
Yeah, I think you're a little broken up there. I think I got the bulk of your questions. I think the question was, do you see a time where, in other words, where we transition to a largely fee-based business? I think you'll see us increasingly change the mix to greater fee-based than we are today. 41% on an annualized basis is the percent of our revenue from fee-based revenue today. It's broad-based, so it's not just the loan platform business. Interchange is becoming a bigger part, in addition to referral revenue, in addition to our ability to drive fees in other smaller businesses that aren't as visible, like our insurance business and our small medium business, which is both loan referral fees as well as checking and savings fees. So I do think it will continue to increase quite meaningfully, but not just because of the loan platform business. I think the thing that would drive it even higher than we anticipate, which we do imagine it's going above 50%, is if we can do the loan platform business meaningfully outside of our credit box. Today, the bulk of our loan platform business is in and about our credit box, just volume that we wouldn't otherwise want to originate on our own balance sheet, both from a credit and risk standpoint. If we can actually deliver loans in the loan platform business that are meaningfully outside the credit box, say 600 to 680, then the revenue stream there is going to be even much, much larger than it is today. We are working on that. I'm optimistic we can get some of those deals done. We announced a piece of that today with Edge Focus, but there's a couple of other deals that are quite large that could be pretty meaningful that would drive that higher. The other thing I'd say about the invest business is that, our outlook and what we're contributing today does not include crypto, which will also be a fee-based business in the invest product itself, but also that we could have a stablecoin pay product with high yield that could drive fees as well, in addition to doing things that I mentioned earlier in the call outside of invest or stablecoins. The thing I'd say more broadly about this business and our desire to own loans, we do want to put loans in the balance sheet and sell those loans and hold them for sale. Our student loan financing business is an important product for us to have. We have that held for investment on a big piece of it, but we'll manage to the best ROE. And that's what will be our guiding light. We want to have an ROE that's in the 20 to 30% range. And so we have to have the right mix of products. So it can't all be fee-based, but we'd like it to be more than 50% for sure.
The next question comes from Kyle Peterson at Needham & Co. Kyle, your line is open. Please go ahead.
Great. Good morning, guys. Nice results, and thanks for taking the questions. I wanted to touch a little bit on, specifically the tech platform and pipeline. I know you guys have a lot of wins that are coming live later this year, but just wanted to see if, given some of the recent market volatility and kind of macro uncertainty, has there been any change, whether it's in client appetite or decision making, or any slowing or change in activity that we should be mindful of, given the volatility over the last few weeks?
No change in our outlook for the tech platform business. Long term, we still have a very strong conviction that is important for the SoFi businesses and helping us deliver our sustainable competitive advantage and the highest lifetime value. Owning that tech allows us to not just have lower costs, but allows us to have superior unit economics and allows us to innovate at a much faster rate. And so it is a part of owning it is for the SoFi business. But the other piece is providing the rest of the world technology services. And our outlook for that is unchanged, even with the more recent volatility around tariffs and the economy and other concerns. We've signed a number of partners that will be integrated this year and they'll contribute to revenue in 2026. Our outlook for this year is unchanged in terms of revenue guidance as well as longer term. I do think there could be an acceleration in 2026 26 relative to 2025 in terms of the number of new deals won and the impact they could have because of the fact that people are starting to move more aggressively into innovative areas and they can no longer compete from an innovative standpoint. If you're a traditional financial institution or you're a big consumer brand that has financial services products, you really have gotten away the last 3 years without innovating. And the reason we've gotten away with it is because of the regulatory environment, because of the backdrop of the economy and interest rates going higher. But in an environment where interest rates stay stable where we're at and we have a stable economy, these financial institutions need to start to compete or they're going to keep losing share. You can see the rate of innovation happening in the private markets. We have more inbound calls than we've ever had for acquisitions and more inbound calls for partnerships than we've had in 3 years. And it's because of the fact that capital is coming back to the fintech sector. It's because the interest rates are now stabilizing and people can start to reinvest. So that's the opportunity set for us. It's up to us to deliver, and we feel confident we'll be able to deliver our share against the tech platform business and for SoFi more broadly for that matter.
The next question comes from Dan Dola from Mizuho. Dan, your line is open. Please go ahead.
Hey, team, Chris, Anthony, really, really nice results. Great to see that. Can I ask you guys about the strength of the capital markets in this market, given the high volatility looks really strong? Would like to get some perspectives on that. Thank you.
I'll let Chris add in more holistically, but I'll tell you when the tariff and volatility stuff happened, I thought some of our deals would get delayed in investment committee or other factors. And we've seen that happen in the past when you had shelter in place for COVID, things came to a screeching halt, and other things have happened in the last 7 years related to dislocations and liquidity, et cetera. We didn't see any slowdown. When the tariff and volatility stuff happened, there was no slowdown. In fact, people were moving just as fast, and it was a pleasant surprise. So that's on the near term. I'll let Chris talk about more holistically the appetite for our assets and the general sector trend that we're seeing.
Yeah, so overall, the strength of the capital markets remains extremely strong, including the loan platform business. This quarter, we ended up selling or transferring over $3 billion of personal and home loans at really strong execution levels. That's over $12 billion of annualized demand in Q1 alone. And then, as we mentioned in our prepared remarks, we also signed over $8 billion of LPB partnerships between Blue Owl, Fortress, and Edge Focus. These recently announced partnerships and other deals are going to drive an acceleration in LPB volume in Q2. So overall, really pleased with how the LPB business has developed, and we're feeling good about the demand, both from capital markets investors as well as from our members.
And I don't think people truly appreciate this stat. We underwrite around $20 billion of loan originations, give or take. And that's not meant to be guided, it's just a round number. We decline $100 billion of loan applicants. $100 billion. That means we've done all the work of building our brand, of driving the demand, of going through an application process to tell more than $100 billion no. That is a huge opportunity for us, and it's going to be high margin, no capital required, low credit risk. Obviously, those loans are being taken away a couple of days after they're underwritten. So it is a big opportunity. So don't sleep on the loan platform business holistically.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, please go ahead. Your line is open.
Hey, good morning. Thanks for taking my questions. Just a couple questions from me. Can you talk a little bit more about how you might position the student loan business if Congress ultimately decides to cap some of the programs out there in Grad Plus, Parent Plus? I know historically that's been more of a source for your refi business over time. Would you be looking to do a little bit more of the in-school graduate side if that happened? And Chris, if you could also just maybe touch on the take rate on the loan platform business. It looked like it increased on the non-referral side this quarter up to about 4.7% as a percent of those originations. So should we be thinking about that as kind of like the sustainable run rate from here, or should it, was there anything sort of one-off in that number? Thanks.
So Jeff, on your first question as it relates to student loans, you're really referring to the in-school student loan market. That's a product that we launched 6 years ago. It's an important product in terms of our mission, being there for all the major financial decisions in our members' lives and the days in between. So if the government backs away from providing in-school loans, Grad Plus, et cetera, we'll absolutely capture that opportunity. By the way, those loans are a lot more attractive than our refinanced student loans. They come at a higher WAC, and they're also typically backed by a co-borrower and a parent. And so they're great ROE products, and we would love to do as much as we can in that market. And we'd be very happy to step in for the government. In addition to the fact that we would not only underwrite the in-school loans, when those students graduate and go get jobs and drive great credit scores, we'll refinance those loans. So it'll be a double bottom line from the standpoint that it's a revenue stream sort of day one, but it's also a member that becomes part of the ecosystem of SoFi. And there's going to be a high lifetime value to someone that takes out an in-school loan from us relative to someone that refinances from us.
Yeah, and then on your second question as it relates to the loan platform business take rate, we are really excited about the momentum that we have there and our improved monetization. You saw that quarter over quarter. I think part of it is as a result of the excess demand that we're seeing from loan investors, which is enabling us to create some pricing tension in some of these partnerships. In terms of the long-term guide on the take rate, what I would think about is each deal is structured a little bit differently. And the majority of the deals that we've done have been within our credit box or stuff that we would otherwise hold on the balance sheet, but we haven't because we're happy with the size of our balance sheet. As we start addressing the large TAM that Anthony mentioned of the $100 billion that we're currently declining right now on an annual basis, you'll see that take rate fluctuate.
The next question comes from
But overall, the only other thing
Sorry, go ahead.
Yeah, sorry. Before you go, Devin, the only other thing I would say is that overall the economics remain extremely healthy. These are high margin unit economics for the LTV business.
Go ahead, Devin. Your line is open.
Okay, great. Good morning, Anthony and Chris. How are you guys?
Great.
Just a question on, yeah, good. So question on just kind of volatility in the market, kind of post quarter end, obviously a lot of moving parts here, but one piece of forward Fed fund expectations have come down quite a bit over the past month. And just curious kind of how we should think about implications on deposit costs, what type of betas you guys are estimating, and then also what are the implications on deposit growth if short-term rates follow market expectations? Thanks.
Yeah, Chris and I will tag team this. In the quarter, you saw that our members within SoFi Money grew 41%, our deposits grew 52%. So we're seeing positive deposit trends, not just from new SoFi Money members, but from existing deposit members. What I'd say is this: we have a competitive advantage. And that competitive advantage is that we have an insured depository entity in a SoFi bank, and we have 4 loan products. Most companies that are not banks that are providing an interest rate on deposits are doing it on the back of a sponsor bank. And those deals are limited in terms of what the APY they can offer. They're typically Fed funds plus 20 basis points. It can't be more than that. And if it is, it's marginally more, maybe Fed funds plus 30 basis points. It is limited. And so it's a really tough strategy to try to live in a world that you want to be a holistic one-stop shop and have a limit on what you could do in any product, whether it's an interest rate on loans or interest rates on deposits. We have an unencumbered capability to compete on APY if we need to, and we will, because we have such a strong ROE business from our lending business that can fund those deposits. And so on the margin, I don't know anyone that can outcompete us on the APY. Now, you may say, geez, Anthony, there's banks with $1 trillion of assets that can do it. They are not going to do it. They could if they chose to, but they're not going to do it. They have a deposit base that is a super low cost of funds, and they have no interest in raising the APY to have more deposits because they just don't need it to lend. But the people that want to get into the business and compete with us with primary accounts, they're not going to be able to compete with us unless they become a bank and they have the lending business to fund that APY. So I couldn't feel better about our position there and how competitive we can be. And again, it will just drive that viral capabilities of all of our products and cross-sell and cross-buy. But I do think APYs are largely going to come down in the industry, but ours is going to be in that top tier and maintain that top tier. We've never gone to the state of where we needed to be at the very top and to maybe even use it as a loss leader. I don't think we have to get there, but we actually have the capability to do it and make it up on the lending side. So I couldn't be more enthusiastic about our competitive positioning. And there's a lot of noise people are making out there that they want to compete with us in that area, and I welcome it.
The only other thing I would add, because Anthony kind of hit on the betas, but to put some more specifics, historically, we've been operating in the 65 to 70% deposit beta range. In terms of overall outlook and what's baked into our guidance, we're at the point where at our long-term funding target of about 85 to 90% of being member deposit funded. So all else being equal, we'd like to grow total deposits at a similar pace to overall loans, which we've said in the last earnings call of single-digit billions. However, if we're continuing to see exceptionally strong member demand, we can grow a bit faster and deploy that funding into funding incremental loans or other assets. And then we also have other ways that we can manage deposits on the balance sheet. So we're not going to stymie member growth at all costs.
The next question comes from Reggie Smith from JP Morgan. Reggie, please go ahead. Your line is open.
Oh, God. This dude sucks.
Hi there, Reggie. Can you take your locally, please?
Fucked up his question.
Sorry about that. Congrats on the quarter. A lot of questions about, kind of macro uncertainty. And these times are very unique in the sense that, I can't think of another period where we had a pre-signaled, potential shock. Usually things happen and we don't know that they're going to happen. I guess my question, Anthony, is how, and it sounds like your funding partners are not linked at all, but I'm curious how you guys underwrite or approach underwriting in this type of environment where you've got, potentially like a binary outcome. Have you made any changes or like how are you guys approaching that specific to your personal loan business? Thank you.
Stupidest question ever.
Yeah. So from a credit policy standpoint, we have an early warning dashboard across a number of external, internal, macro, and microeconomic factors that kind of dictate how we approach credit. In the past, when those indicators have become red, we cut back on credit and we tighten our credit box. We can underwrite across 8 different tiers. There is a period in the last 3 years where we cut back tier 8, tier 7, and tier 6 and just underwrote through tier 5. We're, as Chris has talked about multiple times, we're managing to a lifetime loss of 8%. Well, in a recession, life of loan losses go up. The way you maintain an 8% life of loan loss when losses go up because of a recession or dislocation is you stop underwriting those higher tiers that have higher losses. So that's philosophically how we approach it and from a credit policy standpoint. The economic indicators, they're definitely volatile right now, but not to the point that we need to change our underwriting standards. And our credit performance has remained really strong. We look at entry rates, we look at 90-day delinquencies, and obviously we look at NCLs, all of which have continued to improve and remain very, very steady. I'd say the American consumer is actually doing quite well, and we haven't seen signs that cause us to get concerned. We're 100% willing and able to change on a dime if we need to, but so far, no issues.
Final question today comes from Terry Ma at Barclays. Terry, please go ahead.
Hey, thank you. Good morning. I just wanted to follow up on the Parent Plus and the Grad Plus opportunity. I guess the question is, can you have that kind of in-school grad product coexist with your current refinance business? Because on one hand, I get that it's higher WAC, higher ROE, but then you're also a big consolidator of the loans. Thank you.
Yeah, it absolutely can coexist. There's nothing wrong with prepayments. You just have to factor that into how you value the loans. So if someone's in school and they've taken out 4 years of loans from us, they have a great relationship with us. Hopefully they have a SoFi money account and maybe even a SoFi credit card and maybe a small invest account as well. As they get out of school and their credit improves and they can refinance at a lower rate because they have a credit rating that warrants it, we'd love to do that loan. We just have to make sure that as we think about the in-school loans and as we value them, we have the right type of prepayment levels. We have a great history in in-school loans and a great history in refinance loans to know what those prepayment rates are and how to have them coexist. But our goal is to get people out of debt. Our goal is to help them reduce their debt So they spend less than they make. Spending less than they make involves debt. It's not just their entertainment spending and their household expenses and their transportation expenses and everything else they spend money on. It's also debt. So our objective is to help people spend less than they make and invest the rest. So we can lower their cost of debt. We would love to do that. That's our mission. Refinancing our own loans, I have no issue with that. Even on the personal loan business, if we underwrite somebody at a 14% whack and we help them improve their credit score from 680 to 810, we should absolutely help them refinance that loan. And by the way, we'll make more money in refinancing that loan than we would if they just kept their current loan. It's just we can't overvalue the current loan, and that's why we look at prepayment speeds all the time, just like we do on servicing assets and how we approach things holistically. The member is at the center of what we're doing, not our financial model.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you all for dialing in. We have clearly demonstrated an ability to identify opportunities, lean into those areas that will have the greatest impact, and execute with excellence. And that's because we have a company of great people, a company of people that are focused on building the best culture in the world. And that is the asset that we will ultimately continue to leverage on top of the opportunity that sits in front of us. Our results, in my mind, continue to show that we have a diversified, resilient business that has delivered and will continue to deliver strong growth through a variety of environments, including dynamic environments like we see today. We remain focused on the path to our aspirational long-term goals by executing day to day and fighting the battle right in front of us. As we look ahead, we're confident that the investments we're making today will generate the results that we need to achieve our ambitions. With that, thank you for your interest, and we look forward to talking to you next quarter.
Goodbye.
That's it.
This concludes today's conference call. You may now disconnect.
That's it. Wow. Good call. Wow. What do you guys think? Anybody? Good call. Some weird questions. Not a lot of good questions. A lot of weird ones. Well, stock is up 6%. Is it 6%? IWM is down and QQ is down. Amazon just got downgraded. So markets are a little red right now. Maybe they'll turn around later, but both indexes are down right now. We're up a little bit, 6%. Yeah, I think this could be a delayed reaction back up to 18 over the next couple weeks pretty easily. I think we can get back to 18 pretty quickly. I think you're going to see a delayed reaction. I think you're going to get a lot of upgrades across the board just because of the loan platform business continues to skyrocket. Fee-based revenue is going up. Risk is going down. Defaults are going down. There's really nothing else to say, so I'm pretty happy. Well, let's see what happens by Friday. I think we should be higher than here. So good call. Better than Q4. Increase net income full year. Increase EBITDA. Increase revenue. Increase just about everything. Members, they say they're going to add. What did they say they're going to add? I forgot. But they're already at 3.2 million members new for the year. That's higher than their guidance of, 2.8? They're already at 3.2 million if they can maintain this. So looking good. I want to see some upgrades to the 22 to 25 range. I want to see a couple guys jump to 22, 25. Let's see what happens. That's it, guys. We're not down 10% right now. Hopefully we don't crash during the market open, but look at the headlines. The headlines just say increased guidance all across the board, guys. That's usually when you sell off is when you just you don't increase guidance. You're usually down 5 to 15%. If you look across every headline, they increase full year, they increase Q2. Q2's like 36% growth. Q2's over a $800 million handle. So he said tariffs are not affecting our loan platform deals. Tech platform is going to reaccelerate in 2026. That's all she wrote, guys. So let's see how the market opens. All right, that's it. We're wrapping it up. Good luck, everybody. Hope you enjoyed the live stream. We're green so far. Let's see what happens. Y'all have a great day. All right, later.